Hey all, welcome to Share Trek. This is Raj here. Hope you're all doing fine and you had a great weekend. This is an interesting exercise that I conducted to try and get a feel of how messy the global economic situation is, where is the bottom of the market. And I examined the major economies and compared and contrasted their GDP growth, interest rate, inflation rate, unemployment, and tried to see where each of these countries stand. It's surprising that the inflation level is high in certain countries, but their interest rate is still way below where US is. And I also collectively looked at all of them and added two more data points. One is the corporate tax rate and one is the income tax rate, both of which can have the effect of reducing the liquidity in the economy and therefore give a bit of control over inflation. So I was thinking that maybe interest rates have not gone up that much, but maybe taxes have been hiked. So I did all those kind of things. I must confess that it's a messy picture. At least in one instance, I felt that the unemployment rate of a particular country was contrary to my expectations based on the rate of interest hikes. Anyway, this exercise is by no means a comprehensive exercise, but given our time constraints and the availability of data to non-professional investors like us, I think this is still a worthwhile exercise. I would find that I think that you might find it very interesting to have a look at. Let me take you to the data and conclude with my interpretation at the end of the video. But before we do that, I request that while watching this video, please consider pressing the like button at some point of time. And also, if you are not yet subscribed, please do consider subscribing. And to all our loyal subscribers, please press the notify button because you might get notified immediately when I drop a new video and you can decide when to watch it, but at least you know that I have a video there. With that said, let's get started. First off, let's look at USA. As you can see, inflation rate is painfully high and it's slowly coming down 8.5, 8.3, 8.2 as you can see here. Interest rates have been hiked while unemployment remains stubbornly low and in the 3.5 to 3.7 range for the last 8 months. What this indicates is that despite the interest rate increasing sharply since May, the economy is still strong as we look at the rear view mirror, and this does not show what is happening now. Conventional wisdom is that everything being constant, if interest rates go up, inflation has to go down and unemployment will increase marginally. The problem for the Fed is that the inflation is at 8%, despite increasing interest rate to 4%, and at the same time the fear of tripping into recession is tempering the hands of the Fed. We are soon going to face a moment of truth when the midterms get over this month and one of the risk factors gets removed from the equation. However, high oil prices have the ability to spoil the party by helping keep inflation stubbornly high. Higher interest rates can tank the housing market. So that's what I think is likely to happen here. Next, let us look at Canada. Canada has a high inflation, but it is much lower than US. But the central bank that usually matches US rate hikes opted to settle for a 50 basis point hike this time around instead of the expected 75 basis point hike, probably because the GDP growth is lower. When we look at GDP growth rate of 0.8% and the relatively higher unemployment level at 5.2%, it becomes apparent that the Canadian Central Bank is concerned about tripping into recession. Also, the Canadian housing market is much healthy thanks to stringent mortgage qualification, and hence the chances of a foreclosure epidemic is very low. However, politically, the high house prices and high rents due to increasing interest rates is most probably why the central bank is taking its feet off the interest rate accelerator. Currently, houses for sale in Canada are sitting longer on the market, new building permits are low, and rents are astronomical. US interest rates are going higher, but Canada is not matching the US interest rates as you have seen in the latest interest rate hike that we had. So Canada risks more expensive imports, that is importing inflation, and potential US action on exports like aluminum and lumber as aluminum and lumber become cheaper imports for US. So that's what I look when I see this chart in combination with the US charts. Now let's take a look at Eurozone. Please ignore this slide because I want to talk a few more things before I talk about this particular slide. So in Eurozone, I have picked 5 countries, 3 large economies and a smaller one. And the key point to look at here is that EU zone has a common interest rate, but each of these 5 countries have different inflation, GDP growth rate, and unemployment rate. This is a big problem. The lower interest rates feed into inflation and overheating of the economy. So the smaller economies in the EU with much higher inflation and higher unemployment are suffering. They are facing a double whammy, as we will see later, due to the fact that they have low corporate taxes in order to attract investment. This means that they are flush with liquidity, and that's going to spur the inflation further. But that discussion is for later. So first, let us take Germany. Germany is vulnerable to gas prices as it's a manufacturing giant, and it uses gas to generate electricity. So electricity prices in Germany have skyrocketed more than 600%, because if you see this chart out here, the European natural gas prices have gone up from somewhere around 15 euros per megawatt hour all the way to somewhere around 275 euro per megawatt hour. And if you look at Germany's central bank forecast, they expect that inflation is going to go above 10% in July. And as you will see in the charts that I show you, that prophecy has come true. And besides that, the other problem they have is that the demographics are unfavorable. So if you look at this chart here, you will see that as prophesized, they're already about 10% in October. They're at 10.4%. Their GDP has gone down to 0.3%, and their interest rate, as is common for European zone, is at 2%, and their unemployment rate is at 5.5%. Next, let us look at France. I don't have a separate slide for other countries. This is the last extra slide that I'm going to show you for EU countries. But the common thing for EU is that natural gas prices have skyrocketed. And when it comes to France, inflation is higher but less than other EU countries, but it is still lowering household purchasing power and consumption growth. Business and household confidence is declining. Tight labor market will spur wages and more inflation, according to Italian economists. I do not understand why. I'm going to talk more about this when we look at the slides, but I would just like to mention at a high level that the high unemployment rate in France indicates a mismatch in demographics, talent pool, or cost of employment. As you can see in this slide here, France inflation is at 6.2%. It's much lower than what Germany has, and it still has got 2% interest rate. And the last quarter GDP for France was lesser than the previous one, but it's still a little positive at 0.2%, but it can go away anytime, because if you see just 2 quarters ago, they had a negative quarter of GDP growth. And if you look at the unemployment rate for France, it is pretty high at 7.4. When you look at 9.1%, it's definitely lower than that, but 7.4 is still a high rate of unemployment. And that's what makes me feel that if the economists in France are feeling that the unemployment rate is high, but the job market is going to be tight, then I am thinking that there is labor available for employment, but the labor is not suitable for the type of employment that is available. There needs to be some kind of training or something that needs to be done to ease the tight labor market, or maybe there are some structural issues which are preventing uptake of workers and causing the artificial labor shortage. But that said, let's go and have a look at Italy. I don't have a separate slide to talk about for Italy except for this one. And in this, you would see that there is excessive debt in Italy. That's what is causing a problem for Italy based on my readings about the economy of that country. Again, Italy has got a poor demographic situation, and it has got political instability. So those are all the things that are underpinning what you see out here. So Italian inflation is close to 12%. And their last GDP growth was 0.5%. And the EU interest rate remains 2%, even though they have got such high inflation rate. And their unemployment rate is similar to France at 7.9%. Next, if you look at Czech Republic, which is a much smaller country, they have got a very, very high inflation rate of 18%. And unfortunately for them, the Eurozone interest rate is still at 2%, which is brutal for this kind of inflation. And the Czech Republic has got a negative growth for the first time at minus 0.04 for their GDP, and their unemployment rate is still lower at 3.5% because salary rates are lower in Czech Republic, and their corporate tax rate is also lower, so companies have a much better opportunity to produce and generate productivity in the Czech Republic, and that's the reason why this is so. But still, it has not helped them with their GDP because the demand is being killed by the heavy inflation that you see here at 18%. So that's the story out here. And then if you look at India, let's look at other bigger economies. If you look at India, India has an inflation rate of 7.41%. And if you look at what's happened in India, it's they have structural problems which have been with the nation for a very long time. But then the current government, which has been a ruling party for the almost a decade now, has been steadily working to fix them, and they have introduced structural reforms like GST. They have automated the income tax collection and streamlined it, and they have done a lot of structural reforms which are starting to pay. And they have also automated the entire social security payment system and removed the middleman, so that the poorest of the society get social security payments directly, and that they have plugged all the leakages out there. And that's what helped India stage a much better result out here at this point of time than what could have been if the old method still persisted. So 7.41 is still high, but I think compared to other countries, India has done better. And it has got two consecutive GDP quarters, negative GDP quarters. So India is technically in a recession. And interest rate is pretty high at 5.75%. You can see now, if you contrast this with what is happening in the Eurozone with Germany, or for that matter with Italy having 12% in inflation, and Czech Republic with 18% inflation having 2% interest rates, you would see the folly of this ECB having a single interest rate. It's not good for European Union. It's going to cause a lot of problem for them. Now, coming back to India, you can see that the unemployment rate has dropped in the last quarter to 6.4%. So the labor conditions are becoming a bit tighter. And of course, India is struggling to become a developed economy. So 6.4, I won't hold against that. But if it was a developed economy, I would say 6.4 is a bit high. But the problem for India is that it has got a low per capita income, and the agricultural sector is dependent on climate trends, and that's a major problem. The government has used all its diplomatic currency in trying to keep the oil price low during this Russia-Ukraine crisis, and hence has managed to have a better inflation profile as compared to what could have been. So now let us look at China. So if you look at China, we have China having an inflation rate of 2.8%, which is way, way lower than what we have seen for any other country so far. They have had a positive GDP of growth of 3.9% in the last quarter. They have been steadily cutting interest rates to stimulate the economy. And at this point of time, their interest rate is 3.65%. And if you look at their unemployment rate, it's at 5.5%. And when it comes to China, the Chinese property market is causing a big hangover over the economy, and it's also compounded by the drop in productivity due to the zero COVID policy. Also, China had tinkered with the prosperous and enterprising Chinese tech companies like Alibaba and EV makers. This has led them to losing value in international stock market, and some have delisted from international exchanges and relisted in Hong Kong. And the trade war with USA has not helped either. So that's the situation that we have with China. And if you look at Japan, this looks like among the best in the lot. They have had steady inflation of 3% in the last 2 months, slightly above the previous rate of 2.6. Their GDP growth is still positive at 0.9%, and it's better than the previous quarter. They have zero inflation rate steadily, and their unemployment rate is at around 2.6%. So as you can see here, Japan has got structural issues. They are not able to increase their interest rate because it can upset their housing market. And also Japan imports a lot of raw materials and also exports a lot of finished goods. So any weakening of the Japanese currency will definitely boost the exports, but it's going to cause a lot of problems for it with imports, because the imports of raw materials become very, very expensive. So Japan is in a very difficult situation. It has been trying to come out of the zero interest rate for a very long time and has not succeeded. And many economists were worried about that while looking at US going into zero interest rate situation. Now let us pull it all together. If you look at this particular chart, we see that in some countries interest rates are very high and still inflation is also high. In the case of EU zone, the interest rate is 2%, regardless of whatever is the inflation rate in each EU member country. Each EU member country has got different unemployment rate, different GDP growth rate. Obviously, the 2% interest rate, which is the common factor, is not good for Czech Republic, which has got such a very high inflation rate of 18%. However, the rising gas prices and approaching winter is causing inflation that interest rate hikes cannot solve. We need to look at some more parameters. So I have added two more parameters out here. I have attempted to collect average income tax rate. I have done the research through the internet and picked this from trade economics, and also the corporate tax rates I have picked from them. To take the case of US, for example, US tax rates are very complicated. They have federal tax, which is common for all states, but state taxes are different. Some states don't have taxes, some states have taxes. They are all different rates, and then there are municipal taxes. So there is multiple tiers of tax in US, but we have taken 37% here as an average for the whole country. Likewise, Canada has 33%, and so on. As you can see in this chart out here, this whole column talks about their income tax rate, and the next column talks about their corporate tax rate. And what I'm trying to see here is that, let us say that interest rate is going to remain common like it is for EU. Maybe you can play around with income tax rate, personal income tax rate, and corporate tax rate in order to mop up some liquidity or do some amount of quantitative tightening. Of course, again, in EU zone, you can't do individual quantitative tightening. It has to happen from the ECB. So that's the reason why I had put these two columns here to provide extra information. So I'll just run you through this, and I'll just give you some high-level comments that I have out here. If you look at US, the corporate tax rate is pretty low, and the average income tax rate is also quite low compared to other countries out here. So there's some amount of liquidity coming from the low corporate tax rate, and actually effective corporate tax rate in US is almost zero, because many companies do not pay tax in legally are not required to pay tax in the US, because they can use all the loopholes. So the liquidity is coming in from there. And unless the high income earners are taxed in the US, I think the inflation rate is not going to come down that easily. Now, if you look at Canada, Canada has got higher corporate tax rate as compared to US, but it has got lower income tax rate compared to the US. And the growth is also a bit lower, but inflation rate is much lower than the US. Germany, which has got high inflation rate, has got higher corporate tax rate, and it has got higher income tax rate. Therefore, if you look at from German perspective, I don't think that tax policy is causing them inflation. It's purely driven by the energy costs, and any amount of increasing the interest rate is not going to be of much help in this particular instance. If you look at France, its inflation rate is 6.2, but its corporate tax rate is lower. Increasing the corporate tax rate here can provide a little bit of respite on the inflation, in my opinion, but still France has got lesser inflation than Germany. It has got higher income tax rate, same like Germany, and higher unemployment rate. And therefore, if they increase the corporate tax rate, then unemployment rate could go up much higher. So France would not like to do that. So we have still got to wait for the whole Eurozone to turn around. If you look at Italy's interest rate, it's much higher. You can easily see, because corporate tax rate is lower, and also income tax rate is lower than Germany and France. So that's the reason why you can see that happening there. Now, if you come to Czech Republic, you can very, very clearly see very low corporate tax rate of 19%, very low income tax rate of 23%, flush with liquidity, and you can see how much higher the inflation is. And when it comes to India, India has got a high corporate tax rate, and it has got a high income tax rate. However, income tax rate is not on the top tier, but corporate tax rate is among the highest among all these countries out here, and it still has got an inflation rate of 7.41%, which is still better than most of the Eurozone countries and the US. So India has done way better out here, and it's got a high interest rate, which is also helping it combat the inflation. And then we have China at 2.8%. But it has got very low corporate tax rate, so that's giving a lot of liquidity out there. But income tax rate is pretty good. Japan is doing the best of all. It has got a decent corporate tax rate, not too low, not too high, and it's got very high income tax rate. This could potentially go down a little bit because they have very low inflation. They raise the inflation a little bit, they can raise the interest rate a little bit, and the growth can also go up a little bit. But Japan has its own compulsions. Here's my conclusion. The globe is interconnected. Parts are manufactured in different countries, assembled in different countries, and sold in different countries. Inflation from each country cannot be isolated. Political and economic considerations widely vary for each country, so coordinated efforts will be impossible. In this context, I feel each country is generally going to increase interest rates at their own pace until they tame inflation. I do not have much hope for Europe until the winter is over, and Europe has got a huge political reckoning that it's going to face because the interest rate being common and the quantitative tightening being common. There is going to be a lot of difficulty in the smaller member states where the inflation rate is soaring and that GDP is dropping. So those countries are going to have a very big problem, and especially the gas prices and energy prices being high. It's going to force the hands of most of the political leaders in member states to try and have individual national efforts to negotiate lower energy prices with suppliers. So it's going to test the will of the European Central Command before the winter is over. The inflation has the potential to cause political fracture in the European Union and political instability in the US. Post-US midterm election, if the GOP win, then it will put the additional pressure on Europe, as providing US aid to Ukraine and solidarity against Russia with Europe will suffer a major setback, and investments in the war that has been done so far will be totally wasted, just like the hasty retreat from Syria wasted all the money and the effort that was put into getting some semblance of control over Syria. Now, however, if the GOP did not take the House and Senate, then the current policy will continue and has a good chance of ending the hostilities, in my opinion, in the next 6 to 10 months, as the war of attrition will likely deplete Russian resolve by allowing the West to continue to let the pressure build on Putin, which in turn has the potential for an end to hostilities through internal political maneuvers within Russia. And EU has a long way to raise interest rate, but it is most vulnerable to a recession at this point of time. If there are hostilities between Iran and Saudi Arabia, then energy prices globally will skyrocket further, and the US releasing strategic reserves will not make a dent. That would lead to global recession. In my opinion, the situation calls for mature and responsible leadership in all countries to get together and drag the world economy off the precipice. So now back to the question of, when will the markets turn bullish, or have we hit the bottom of the market, which was the initial question that led me into all this analysis? Well, the answer is as clear as mud. It's very difficult to tell. Right now, it seems like we are going to be in a bear market for quite a while, because things are not going to resolve by themselves. Each country is going to muddle through their own approach and try to get a lid on the inflation, and also try to make sure that their political and social peace is maintained. So what happens in a recession? Let's look at that. So recession is a foregone conclusion, in my opinion. So what should you expect in a recession? The S&P 500 surprisingly rose an average of 1% during all recession periods during 1945. Since 1945, according to historical records. That's because markets usually top out before the start of recessions and bottom out before their conclusion. In other words, the worst will be over for stocks before it's over for the rest of the economy, because investors are always forward looking and try to buy the opportunity share in advance so that they can get it at a discount and then sell it when the premium is realized. In almost every case, the S&P 500 has bottomed out roughly 4 months before the end of a recession. The index typically hits a high 7 or 8 months before the start of a recession. The conventional wisdom is that S&P 500 declines significantly during recessions and often begins to fall well before a recession starts and rebounds well before the recession ends. So everything points towards S&P 500. So let's take a quick look at S&P 500 and see when it peaked. I don't see any reason to hope for anything different this time around in terms of recovery from recession, except for the Russia-Ukraine crisis. So let's quickly go into the TradingView platform and look at when S&P 500 peaked and where it is right now, and how many months have passed since we peaked in S&P 500. And then we'll start doing a little bit of analysis in terms of let's go back to all these universal wisdom about what S&P does when recession happens and draw our conclusions. So let me go to the TradingView platform right now. Well, friends, here we are in the TradingView platform looking at QQQ. Oh, this is QQQ. Let's go to S&P 500. Sorry, S&P 500. So here we are in S&P 500, and we peaked at around 470.94 somewhere on 4th of January 2022. Since then, we have been steadily falling, and we are in a bear channel. Let me draw some channel lines out here so that you can visualize this very, very clearly. So this is the resistance for us, and now we are going to look at the support that we have. This is the line of support that I can see that we are following. So this is a huge bear channel that we are in, and right now we have got support at 369.94. And the reason why we came here is to look at where we peaked out. And I'm just going to pull this line out here because it's coming in the way for me. And now if I look at this point out here, somewhere on 470.94 is where we peaked on 4th of January 2022. Since then we have been falling, and it's almost 11 months, the 11th month running. So typically they say that S&P 500 peaks 8 months before a recession. So potentially, I think that we could probably be in a recession at this point of time, and we need to bottom out before we can recover from a recession. The conventional wisdom is that the S&P 500 hits a 7 or 8 months high just prior to the start of a recession. And if we look at where we had the recession, where we are now, right now, I think that we probably have been in a recession at this point of time. Maybe we don't know it yet, because recession is always much more apparent after we cross over it and look back. So at this point of time, the data we have does not show us a recession, but potentially we are very close to a recession. And I think when we turn around, S&P 500 will be the first one to bounce back. So if you look at this particular slide out here, you will see that January, February, March, we were negative. April, May, June also we were negative. So if you put that as a comparison, so after looking at that slide, if we look at the chart out here, this is where we were in June. So June we had come to a bottom of around 362, but this has not been the bottom of S&P 500, because S&P 500 fell down much more sharply, much more. Like if I move this line, you can see it clearly that we went as low as 348.78 on the 14th of October 2022. So we have fallen much more, and therefore I don't think that we have reached the bottom yet. The bottom is yet to come. So there is not much clues out here either. So friends, it's very difficult to draw a conclusion, and that's the reason why it's difficult to make money in the share market. Like, we may have a lot of technical analysis, we may do fundamental analysis, but the economy is so huge, the numbers are so huge, the variables are so many, that it's very, very difficult. But on hindsight, we can always look back with the benefit of hindsight and say, oh, that's when we started a recession, that's when the recession ended, and then we had a 20% growth. But in the moment, at this point of time, I find it very difficult to say whether we have reached the bottom or not. However, given the fact that we could be in a recession, what is it that happens in a recession? Well, healthcare, food, freight, and logistics, they perform much better during recessions. If you look at Maslow's theory of hierarchy, food, clothing, shelter, these are the basic needs for all humans, whether it's recession or otherwise, they will be in demand. People are not going to reduce the use of salt during a recession. They may reduce the use of sugar. by having less confectionaries and less cakes and other things, but salt is an indication of the basic necessities. The same way when it comes to food, clothing, and shelter, maybe some special kind of clothing and all may not be having that kind of a demand, but the basic clothing will definitely have the demand, the basic housing will definitely have the demand, the basic food will definitely have the demand. Like fast food joints will do very good business during recessions, whereas a gourmet restaurant or something like that might have a bit of difficulty. Also, it's a good policy during recession to have 6 to 12 months of living expenses handy in case of unemployment. So that's another thing that I would suggest. So those are the things that one can do during recession. And also during recession, share markets will plumb the depths, and that's the point of time to do a really good dollar cost averaging. But you know what the funny thing is, that when it is recession and when everything is very cheap, most people do not have the money, and they will just see the lower price of the stocks. They will be just pulling their hairs out saying that, God, I wish I had some money so that I could buy it. And that's the reason why the share prices will remain low, because nobody has the money to buy even though the prices are low. And when people start getting the money, the share market will start going up very fast. It's always a chase, and we are always a step behind. It's always like the dog chasing the bus. The bus is always ahead of the dog. We are the dogs here. The stock market is the bus. And we'll see what happens when we go ahead. This has been one of my longest videos, friends, and if you have been watching right now until this point, thank you very much. Sorry for keeping you up so long. And with that said, I think some other day I will take up some points from here and put another video with much more concrete conclusion if I get some hints of where the economy is going. That could probably be a part 2 for this. Please let me know if you like these type of videos, and if you like this video, of course, please don't forget to press a like out there. If you're not yet subscribed, please subscribe and help us grow this channel. Thanks and have a great day. Bye for now.